I am currently standing outside of a duplex that I sold to an investor a couple of years ago, and it got me thinking. Here's a quick video on some of my favorite real estate investing rules. Number one, money invested is better than money sitting. So when you're looking at deals and you're doing your math, all that knowledge is very good when making a decision, but don't have analysis paralysis and taking too long to do it. Sometimes you might see a really good property that comes on the market, but then you just get too scared to make that jump. So have your money sitting because you can always move it later. You can sell the property, you could do a HELOC, home equity line of credit, you could do a refi, you could pull that cash out, you can move it, you can 1031 exchange. But if your money is not invested, you have none of those options. When you're looking for property, always double check the location, the zip code, the school district. Don't sleep on the fact that even though you might be paying a little bit more money and cash flowing a little bit less on a rental property or an investment in a better area, your appreciation will be higher. So typically with multifamily, you will find them in higher density neighborhoods. So higher density means that there's a lot more people, a lot more traffic, a lot more wear and tear. They tend to sell for a little bit less. So you're thinking, oh, maybe it's cheaper, but the rents are also a little bit lower. So check that number cash flow. You might be cash flowing higher in the lower neighborhood, but if you were to spend more money to get in a nicer location, your appreciation is going to be higher and your overall value of the property is going to increase as time passes, making it a better investment. And as you get better and as you have more experience with real estate investing, don't be scared to diversify. Let's say you start with single family. Let's say you start with new construction. That works really well for you. Don't be scared to transition to multifamily or to triple net leases or commercial, or maybe go out of state, find a different market to invest in. That way all your eggs are not in one basket. If one sector of the economy suffers, maybe another one won't. A couple years ago, when everything was getting locked down and people started working from home, a lot of the office commercial spaces were really suffering. A lot of people were closing their doors and moving people to work from home. The people that only owned office buildings suffered. The people that owned retail and office and restaurant and multifamily and single family, those people rode out the wave and ended up coming out on top. I cannot stress this one enough. If you're financing, if you're doing a conventional loan, if you're doing commercial loan, don't underestimate how much your credit score, your income, your tax returns, who you are as a person, who you are as a borrower. Don't underestimate how significant that is. Protecting your credit score, making sure your taxes are buttoned up, making sure you have a schedule of real estate owned that looks good, that shines, that you have a resume, that you have experience, that you build relationships with lenders, because ultimately the value of your real estate portfolio, you're gonna have your assets, you're gonna have your debt, you're gonna have that equity in between, your cash flow, everything is going to be determined based on what type of financing you secure. So a better borrower that's going to get a better rate is going to have better numbers per month and in general, as opposed to somebody who is constantly opening credit cards or always having tax write-offs, their taxes don't look good, or who didn't take the time to build a relationship with a lender. They're bouncing around from bank to bank. It's very important that you have your financing locked down. And then also understanding everything that goes into it. So when you're working with a lender and they give you a closing cost worksheet, don't just be like, hey, it looks good. Look at your rate, look at your monthly payment, look at your out-of-pocket cash to close, because sometimes they may be buying down the rate for you and you don't even know it. Look at the settlement statement, make sure the deposits are getting transferred. Understanding the financing is maybe 75 to 80% of what makes a deal a good deal or not. People tend to only look at the purchase price, but that's such a small factor. You look at the rents in the market, but the rents in the market aren't going to play as important as a role as making sure you've secured really good financing and understanding everything on the other side of it. So when you're working with a lender, don't be afraid to ask 1,000,000 questions. Last but not least, I know I touched on appreciation and the value of a property. A lot of people tend to only do an analysis on a rental based on income and expenses. They're not really thinking long-term, but everybody that's been in this game knows that real estate investing is a long-term play, and that's where a lot of the money is made. I have a property where I cash flowed $500 every single month for about 3 years, but then I sold it for $200,000 more than I bought it for. Broken down per month, it's not that much. Overall value of my return on the cash invested, priceless. There was another property that I bought, and after holding it for a couple of years, with all the rents, with the appreciation, with everything, I ended up making $1 million off of it. The rents weren't even that good. It was the location, the appreciation, selling at a good time, buying at a good time. There's so much that goes into it. Make sure you're not just looking at the monthly income. Thank you for watching. If you have other tips and tricks that you want to share with other investors, leave them down below. And again, my name is Allie. I'm a real estate broker in the state of Oregon and Washington, and I help investors find investment properties and flips every day.